I want to shift away back to the broader markets here as we are seeing the indices hit their session highs. We got a stronger than expected jobs report out, I should say unemployment report out this morning, hitting a new fresh pandemic low in terms of the initial jobless claims number, coming in at 444,000 versus the 450,000 expected. That was also down from the 473,000 we saw during the prior week. Continuing claims came in maybe a bit stronger than people had been expecting, but notably kind of in this theme of Americans getting back to work. And it raises questions about not only inflation, but also what the Fed's going to be doing if that stronger hiring spree continues here, what it means for markets. And for more on that, I want to bring on our first market guest today. Diane Jaffee is TCW Group Managing Director and a Senior Portfolio Manager there. And Diane, appreciate you taking the time here to chat with us. I mean, we're talking about maybe the Fed. Some of our more hawkish guests have been pointing out that the Fed's going to be forced to move a little bit quicker here in tapering and raising rates. What do you make of what we're seeing on the jobs front now and the difficulties employers have getting new workers in and how it plays into that thinking?
We're super pleased with the jobs report today, the unemployment report, much better than expected, and it shows that we're on a continuing accelerating trend for the economy to be recovering, but it's not going to be a straight line. There's definitely going to be an up and down every day or week, and it's great for active managers actually to take advantage of those opportunities. In terms of the companies, we're paying very close attention to all the companies' earnings, and it seems to us that the companies that are able to keep a relatively low turnover, whether it's through training, whether it's through maybe their unions members that they have under their employ, they have been able to kind of work through this process and not have a lot of wage pressure. We heard that definitely from Lennar earlier in their reporting season. We heard it from Albertsons and the grocery store chain, and most recently with Target's report saying how training and support for their staff during COVID. And of course, keeping their wages up makes a big difference. Where you see companies with very high employee turnover, I think it is going to be very difficult. And so the Fed is going to be watching the employment cost index, because we can see spikes in lumber, we can see spikes in other commodities, but really what's super sticky would be wages.
Yeah, and I mean, and we haven't necessarily seen a lot of improvement on the wage front, but when you think about what we got in the Fed minutes yesterday and kind of this framework that Jay Powell has laid out in terms of it being too early to talk about or think about raising rates and kind of the dance that's playing out there, what do you make of maybe how the market would react to, I guess, maybe a quicker than some people expected in discussions around tapering if that were to come earlier here in the summer?
If there's a policy mistake, it's a policy mistake, and that will unnerve the markets. I think that when they eventually do taper, hopefully it's in an environment where their two main points of full employment and stabilized prices are in, good comfort zones for them. Then when they taper, it will be much better. And I don't want to put the cart before the horse on that.
When we talk about where investors should be playing this right now as they're kind of getting this bounce back, and you talk about maybe wage pressures there, I wonder how that fits into maybe this thesis of going back towards value names, restaurants, et cetera, that could see big booms, but also rising costs if labor does get costly. I mean, how should investors be maybe adjusting portfolios now to counter for that?
That's a very good question. We're big believers in diversification. One of our main process points is to always have exposure to all the major 11 sectors of the economy. And we went to a natural underweight in consumer staples at late last year because they had done so well during the pandemic. And consumer staples in general have a trickier time during periods of inflation because their margins are so thin. Whereas a tech company, generally speaking, they're going to pay their employees more, and there's a lot more room to absorb costs or increase productivity. Consumer staples companies, with some exceptions, Pepsi has done a great job in terms of guarding for inflation. They don't have any commodity cost pressures greater than 10%, and they have decades of working through periods of inflation. So there are, of course, some exceptions, but we were happy that we went to a natural underweight in consumer staples at the end of last year because they're one of the sectors that would be hit the hardest.
Yeah, and one of the things I have to be careful of too, and how I phrase the questions, is a lot of times we're very U.S. focused here. I say, what about that surge in restaurant demand? Because obviously, if we're in this country, you're going to eat in this country. When we look at some of those other value sectors, though, cyclical sectors and airlines and travel, a lot of guests pointing out now that this global recovery, obviously, the U.S. is kind of in a league of its own. But when you look globally, I wonder what kind of impact that might have on some of the other prices we watch, mainly oil, when we think about this longer recovery in emerging markets and what else plays out there. How does that kind of fit into your take maybe in the energy sector and commodity prices on that side?
Zach, that's an excellent question. Commodities in general are priced in dollars. So if the dollar is declining and you're in an EM country, an emerging market country, and you're exporting a lot of oil, that's not going to necessarily be good for that EM market because now the price has gone down. It's great for U.S. exporters, of course, if the dollar goes down. But for any EM market that is really focused on commodities and the U.S. dollar has been trending down, it's not going to be beneficial for them. If they are an importer of energy, though, that'll be great.
Yeah, that's the sweet spot right there. It's a tricky time though, trying to piece all these things together, and you have different recoveries coming at different paces. But appreciate you coming on here to chat with us today, Diane Jaffee, along with us here, TCW Group Managing Director, Senior Portfolio Manager. Thanks again.